Good morning. We're here to talk about the all-in-one and one specific scenario, but just kind of a introduction to the all-in-one. It's basically derived from the Australian mortgage model, which was called a interest only with an offset account. And what that means to you is it is a mortgage and bank account, checking account, all in one. And how it works is the rate is not fixed. It basically varies based off of the SOFR 30-day average index. For example, February 28th at midnight, the 30-day average for SOFR was 4.3. So we take that 4.3, add your margin, which starts at 4 unless you were to buy it down, and that gives us an 8.3. It's a 30-year amortized. So 8.3 amortized over 30-year on March 1st at the end of the day, whatever it's in the account, it sweeps the account. So your principal balance and what's in your checking, they add it all together and they take that 1 day interest calculation after they've done the whole 8.3 over 30 years, and they calculate interest on what's left. So if you had a $700,000 loan balance and there's $500,000 in your account between principal and what's in checking or whatnot, then they're only charging you that daily interest rate on that 200,000. So what it does is it turns this into a principal compounding loan. So each month it only takes interest that it calculated out of the account. So you're not writing a mortgage payment. You're not automatically sending a mortgage payment each month. It's just taking the interest only out, leaving everything else in there available to spend just like any normal checking account. And one key feature to this is I mentioned if there's $500,000 in the account, FDIC only insures 250 most of the time. This money is actually secured against your asset. So knowing that principal compounds in this type of loan, and some people like to pay off their loan fast by double paying or paying every 2 weeks or sending an extra thousand towards principal. That's great. But once you send that, it's gone unless you're to do a loan and HELOC or refi and pull the money out. You send an extra one, two, or $3,000 towards your principal in this type of situation, you could pull it out the next day because all you're doing is positing in your account or leaving it there. So the scenario I want to go on right now is let's say you're an investor, let's say you're flipping, and you have a home that might have a small balance, a loan on it, right? And we're going to refinance it into an all-in-one loan, turn this into a bank account for you because you want to use money to flip homes, and it's hard to get loans to either build specs or flip or anything like that unless you go to hard money. So we want to get you out of hard money and creating your own bank account and your own basically lending to yourself. So on this scenario, we're going to do a $1.5 million estimated home value. And since it's your primary residence, we can take out up to 80%. So we're going to pull 1.2 million. And let's say just you owe 500,000 on that loan. All right. When we cash out, we're going to pay off that $500,000 loan, and then we're going to wire you the other $700,000 to your account. It takes 60 days to set up the account. So that's why if you need that money in between or you got to flip you're working on or whatnot, we're going to wire that money to your account. And then as soon as this account's set up, you get to wire that $700,000 back. So we're going to put $700,000 on a one-time deposit on month 2 because that's when it'll be set up. Now, repeat deposit. Like I said, this is a bank account. So we want to, you can do ACH, you can do direct deposit, you can do, treat it just like a normal bank account. Another scenario that we'll get into at another time is a kind of a rental working capital account where all your rents come into the account, all your expenses for all your rentals go out of the account, and it pays itself off faster. And you actually get to tap into the money it creates to buy more rentals and, uh, compound the situation. So let's say in this case, married couple net brings in about $12,000 a month. That's what we direct deposit into your account. And we'll say that's monthly. Because literally on a $1 million purchase, you're going to need to have that much money coming in. All right, so we're going to go. So we put the $700,000 back in. Next, we are going to tackle the insurance issue, which would probably be about, let's just call it 700 a month, taxes and insurance. And then we want to do how much is left over. All right, let's say you don't have other assets. We're not going to count the mortgage because that's built into the simulation. It's already taking it out. It's already calculating interest. So we're looking more for like cars, student loans, credit card debt, and whatnot. So let's say you have an average monthly expense of $1,400, $1,500. All right. Then we calculate results. So this is in comparison to where if we would have taken that home, cashed out the $1.2 million, and let's say you had $700,000 that you needed tomorrow to do your flip. Okay. Great. Well, as you can see here, if we just did a normal loan on a 6.875 rate, cashed it out, gave you your $700,000 on the 30 years, your total expense is 2.8. Well, here, all we did was direct deposit your money into your account and pay your income coming into your account and paid back the expenses or whatnot. All right. That's telling us that you'll have 1.2 million back in that account ready to use in just 5.4 years. All right. So you really just paid off the 500,000. As I was saying, we're going off of a rate of 8.352. That's the worst possible rate. Okay. Let's go back here. We're going to go to historical average. And now that let's start looking at how things can, how you can use this account. So spending, we're going to say in month 9, all right, you've identified a flips. It's going to cost you $500,000 to take it down and renovate it, and you're going to put it back up for sale. Say month 9. And then in month, say it takes you 5 months to get it done and sold, you're going to put 600,000 back in there. That's month 15 or 14. All right. So now we just paid it off faster by doing a flip out of it because you made money on the flip. Okay. Let's go back here just for a quick little sidebar. And let's say you bought a rental for cash for 500 to hold and you didn't sell it and you didn't get that $600,000 back. All right. Now, 12 years, you're paid off. So not only did we pay off your $500,000 original loan, but you went out and bought a $500,000 rental and held it, and you still have $1.2 million in your account by year 12. I'll show you this pay down table. All right, we put $700,000 back in on month 2 because we didn't use it, but then we used $500,000 on month 9, and then this money's all available. You can go do DSCRs because DSCRs doesn't require income. You could be dumping $100,000 every few months and buying a new DSCR property with $100,000 down under an LLC and actually turn this $12,000 into a higher number because you have more income coming in. But let's go back to that deposit. We're going to put that back in there on month 14. And we already saw how fast that closed. It was 4.3. Let's just show you again. 4.3 years. All right. Let's go buy another flip. Let's say you close that one and 4 months later, you're right back at it. Let's say you had 475,000 out of pocket, month 18. One time, let's go back to the deposit. Let's say you made, let's say 550. You deposited back in there on month 24. Save and close and calculate results. So see how fast you're paying this off faster. All right. We're 2 years into this. And let's go back to that pay down table because this is beautiful. So you sold it, put the money back in there. Now you have 870 available on month 14. You went and did a flip, sold it. Month 24, you have 1 million available, right? And then it's not going to be too long. You're looking at 20 more months if you did nothing, and you'd have $1.2 million to spend. So as you say, we can do one more. Let's buy one more in this short period of time. So let's say you did a doozy. Let's say you went after it this time. And let's say we did that in month 28. All right. And then it took you a little bit to get it sold, but maybe you sold it for 1 million. And you got that back on month 35. So yeah, you did that in 3 years. You did 3 flips and you still have $1.2 million. At this point, now we're going to look at maybe either if you have another asset that we can do another all-in-one loan, because you can have 3 of these and you could build capital available because you can wire this money anytime. You don't have to ask for it. It's a bank account. You don't have to pay fees on it again. You don't have to pay hard money points, nothing anymore. You could take that 1.2 million, go buy a lot and build a house, a spec, a duplex, whatever, and whatever you want. And you don't have to ask for the money because it's yours. So I would say once you have got it to $1.2 million and it's sitting there, let's either go buy an investment, a big one, like a big fourplex for $1 million, or go buy another home. Maybe you want a bigger home. Go buy a $2 million home. And we can use this all-in-one to purchase as well, not just to refinance. We can use it to purchase and create the biggest credit line possible. And like I said, you can get 3 of these. Max loan amounts are $3 million each. So you could technically, if you worked it right, get up to $9 million in available liquid at any given time. So that's the magic of these. Reason people don't know about it is they don't talk about it much. It's different from a normal mortgage, right? And there's two sides look at it. Either you look at it at a cost savings or an interest rate. If you're interest rate focused, you're never going to use this because you won't get past the 8.3. But the fact is, look at this here. The fact of the matter is over those 3 years and everything you did, remember, you would have needed hard money for some of these, right? These takedowns, whether it was to take down the house or to borrow for the renovations. And this was the APR on the fixed one we took out right at the beginning and closed, and we were done, right? 6.875. Over 3 years, your effective APR on this money, which you have in the bank and available to use at 3 years, was 0.688%. You'll never see that. And we started at 8.3%. So this is for people who work with money, have money coming in. It works for somebody who wants to pay it off fast and has leftover money. Um, there's a lot of great uses for this, but it's not for the paycheck to paycheck guy. It's not for the person who wants to get the 2.5 rate and stick it on a shelf and show everybody their rate. This is for people who want to save money and make money on this loan. So hope it makes sense. We can dive deeper into other scenarios. Just reach out and let me know. But anybody that's investing, anybody that's financial savvy, the scenarios will make sense. Even against a 2.5 rate, we'll beat it. I mean, we just beat it with this one. And it was a minimal deposit each month, and we flipped 3 homes and it's paid off. Okay. So reach out to me and we'll go from there. Hope you guys have a great day.